It's now Thursday, the day after CPI data was released, and the stock markets are holding firm today. We're here to discuss the outlook for stocks and gold miners with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris, welcome back to the show.
Hey, thanks for having me, David.
Let's start by analyzing the stock markets like we always do. So today's market action, not a lot of action in the stock markets, in the broad indices at least. So let's take a look at the larger picture. Can we pull up an S&P 500 chart? So obviously yesterday we had a lot of action. CPI was released. Some fear selling, I've noticed, but it's more or less stabilized today. How are you sensing things progressing?
Yeah, so the market's had a really good run over the past month and change, and I've been telling followers, like, listen, we're going to get a 2 to 4% market pullback any day, and you should be prepared for it. Really, that's starting to happen. I think there still might be a little bit more downside. The short-term analysis on the SP 500 is actually still pointing to a bit lower pricing. We saw a nice gap up today that we're doing this interview, but gaps to the upside on the SP 500 are actually bearish. The market makers can run the market up in pre-market, and then when it opens up with liquidity at 9:30, they can dump their shares at a premium before the market kind of really collapses. And so that's what's happened today. We saw this gap up, which looks good. Investors get excited, but it's usually going to be short-lived. And I still think there's some more downside in the stock market. Not a whole lot more. We've got potential to get down to this pink line, which is the 20-day moving average. And I think if it can get down to that area, I think this market will be cleansed out. All this is a simple bull market kind of buck. You can see in the past, you have a rally, then you get a really sharp 3-4 day pullback. A rally happens over and over again. And that's what the market tries to do. It tries to shake people out, create a spike of short-term panic and fear, so people get rational and start to dump their shares.
Yeah.
And we saw that yesterday. We started to see some fear. The VIX is up. And this is a really good thing for the market. I'm very bullish on the stock market right now. We have been for a while. And I think it's got a lot higher to go, but it definitely needs to have some pullbacks along the way.
Chris, you've no doubt seen some of these internet memes. Stonks only go up. Buy the dip. It's the good strategy for any situation. Let's actually take this seriously and analyze it from a technical and perhaps fundamental perspective. If you take a look at the entire history of the S&P 500, over the long term, yes, it's only gone up. We've had corrections, crashes along the way, but if you had bought those dips, you would have made a lot of money. So is this actually, jokes aside, is this actually a prudent strategy for any investor to take? Anytime you see a dip in the S&P or NASDAQ or Dow Jones, you buy the dip and you just hold, and perhaps you buy more on the next dip. And that could be your life savings. What do you think?
For sure. If you are a long-term passive investor, when there's blood in the streets, when the market has a pullback, there's no doubt. The markets in general are going to always go up long-term. So if you are super passive, you put money in when the market's selling off, when you get really nervous, that's when you actually dump money in because you know it's going to kind of boil back up to new highs over time. So it is a very good strategy. Most people don't happen to do that. It's hard to buy into fear. It's very difficult, but if you can do it, it's a very strong strategy going forward. It'll give you a lot more potential down the road in terms of long-term kind of retirement funds. If you can manage your long-term capital, you can have 2, 3, 4 times more money in retirement if you manage that kind of passive index investing style.
So put some money aside every month and just put it into a passive fund tracking the index, and over the long term, you should do well, is what you're saying. Yeah. Well, sure. you mentioned that it's difficult to buy into fear. You're right. Well, it's even more difficult selling into euphoria. Most people see a big market uptrend or a rally, and they think, well, it's going to go up higher, and then sometimes it doesn't, and they lose all their gains. And so how do you discipline yourself as a trader to say to yourself, all right, Chris, it's time to take profits?
Yeah, well, it really comes down, trading and investing comes down to having the proper mindset, the proper expectations of how the market moves and what you're actually going to get as returns. So a lot of people think that they can buy a dip and buy the bottom. They think they should, when there's a market sell-off, a huge crash, they think, you should have seen it coming and that you should have got out near the top. The reality is, of any trader, it doesn't matter if you're a day trader on the 1-minute chart or you're a monthly investor, monthly chart investor, you're never going to get in at the bottom. You're never going to get out of the top. And you just need to have rules to say, hey, we're in a new uptrend. I'm going to put new money into this market because this pullback has turned around. It looks like it's going higher. I'm going to invest more money. When it's in a euphoric stage and going straight up, I mean, it is super exhilarating. It is hard to get out. And you're not going to just randomly say, I'm exiting here 100% of my position. You shouldn't do that. You should scale out as it's moving up, but you've got to keep your at least some portion of your account in there. Eventually, it will roll over enough that you're going to have rules in place saying, hey, this is actually reversed. It's got signs that it's topped. It's in a new downtrend. I'm going to exit the rest of that position. And whatever that gain is, it'll, if it's a high momentum stock, it might be 10 or 15% off the highs from where you're getting out. But you can't look at it as you missed out on all those gains. That's just the way trading is. You just need to make sure you've got rules to get out when that euphoric kind of rally comes to an end.
Would you take profits now, given how much we've already run up this year and last? Take some profits?
On which time frame would you be speaking about? So for example, we took profits on our NASDAQ. We are along the QLD we're along the QLD. We're also along the QQQ with two different strategies. We sold a quarter of the position last week at a 7.5% gain on the QQQ. The other one is a different strategy. We're actually still holding it for a longer term trend because I think that's going to go a lot higher. In fact, if we take a quick look at the QQQ, you can see our entry. We hit a 7.5% target here. We're expecting the trend to continue to go up. So we're just going to ride that out. In terms of long-term investing, you're still fully committed here. And we're not taking anything off because I think there's still quite a bit of upside potential. So it really comes down to your strategy. When you look at the SP 500, it's had a couple times where we moved to cash. We'll move to cash. A couple little tiny signals here where you get out and get back in again because you just never know when one of these market conditions are going to turn into a crash, right? So it's all about managing your risk. When the charts and the sentiment and what the big money flows are saying are telling you that this market is actually going mixed, there's no real direction, you're really best to step aside. And when it comes to the SP 500, we can see here's our signal on the SPY. It's had a really nice run up. It's pulling back. But when you look at this strategy, we can have multiple pullbacks along the way where we don't get out, or we'll scale out of this particular strategy as it goes up, and our trailing stop will follow it. So where you're getting out totally depends on your strategy. One of them we're still long and not taking any. Some we already just pulled some off last week. So it's very unique to the trader.
It looks like the momentum has been stalling, at least in the short term. Do you foresee a crash coming or a major correction coming anytime in the foreseeable future, anytime soon?
I think there could be a huge crash, but not till maybe February, March. I mean, it's so forward looking and really just kind of a prediction, obviously. But when you go back and you look at what the Russell 2000 is doing, if we go back and we look at the Russell, the IWM, it has got this big bull flag pattern. It's just starting to break out. The mid-cap sector is also doing the same thing. And these patterns are pointing to, from where we are now, about a 20 to 30% rally to the upside. So I feel that we could see one massive rally in the overall stock market. I think we'll see precious metal miners come to life and become a market leader, maybe January timeframe. And we're going to see huge gains. But then I think that could be that euphoric phase of everyone who didn't get last year's rally saying, I'm not missing this next one. And it's going to suck the rest of the money in. And then we see a huge crash early next year. But, we got to watch the charts day by day for that.
Yeah. Or it could just be people window dressing before the end of the year, selling their underperformers and just rushing into whatever momentum has been built up. Let's talk about some of these sectors that you like and, of course, don't like. If you could take a look at my screen here, I have a list of the sectors compiled, and it shows the performance of each of these sectors. The top performers this year, as you know, energy, tech, financials, discretionary. So a lot of these discretionary risk-on sectors and the underperformers, the more consumer staple side. So utilities, conglomerates, healthcare, transportation, and non-cyclicals. So going into 2022, do you think that this pattern of risk-on appetite will continue?
I do. Based on kind of cycles and the price patterns and how long they take to play out, I think we could see a very bullish market here going into the end of January. I think we're going to see technology do well. I think energy is kind of coming to an end. Crude oil to me has got about an $88, $89 per barrel cap level. That's where I think the big chart momentum is going to stall out. We're pretty darn close there, but we might have one more little push, and the energy sector stocks might have a really strong push here that might only last a month or so tops. But I think the energy sector is coming to an end. In fact, if we were to take a quick look at natural gas here, and if we look at the weekly chart, you get a really good feel of where we are in these huge, massive cycles. So every few years, we have a huge, massive kind of blow off spike in natural gas. And I've been talking about this based on cycles. We are in one of these high volatility points where this cycle is coming to an end. We've got huge volatility. Crude is also at a resistance area. So I think the energy sector is on its last legs. It's been very strong, but it's almost over. I think technology is going to be a very strong sector. I think we're going to see a lot of ETFs like the ARC ETFs. I think they're going to come back to life. They're still all putting in a basing formation. They haven't turned to the upside yet, but they are showing signs that they're like ready to rally. And the fact that the mid and the small cap stock indexes have broken into a new bull market, that's a sign that all those really speculative stocks are going to start to rally in a big way. So I like technology probably as one of the best sectors going forward. I think financials could do well with rates going up. It's going to help benefit, I think, the banking system short term. But obviously, if we start to have major defaults, there's going to be people worried about holding on to financial stocks. So I think tech is still kind of the strongest and the best place to be.
All right, so you like tech, you like financials. What don't you like then?
I think based on the chart patterns showing stronger prices, I think you want to kind of stay away from some of the more boring assets, which would be like consumer staples, utilities, potentially bonds. I mean, all these things are pretty boring. If we're seeing all kinds of stocks rallying, if the stock market rallies here another 20 to 30%, we're going to see individual stocks running hundreds of percent. So no one's going to be really wanting utilities and consumer staples, all those boring things, right? So those are the ones I think could lag for a little bit. I think they will come to life a little bit later, come January. And that's also when I think precious metals and miners will really start to come to life. I think the gold miner and silver miner sector, they're kind of a late bloomer. They come right at the end of a stock market, kind of a bull market. And I think they're going to become a leader. They're going to go from the bottom of our pile. We've got our banned hot list here. We've got GDX down at the bottom here. We've got SLV. They were in bear markets just about a week ago, which is the bearish. This is the long-term stage of it. And they have moved to a recovery stage. Now they're in yellow, which is accumulation. So they're starting to just get some momentum to them. And they're about to start, which I think is going to be another bull market. Gold should rally to 2,600. Gold miners, I think, will have a huge explosive move. But again, I don't think they're going to break out with the stock market as much. I think they're going to slowly keep warming up and kind of creeping to the upside, and then just take off come late December, early January timeframe.
Huge explosive move. What do you mean by that? What are we looking at then?
Well, when we take a look at, let's just take a look at GDX here. I mean, we've got this long consolidation. I think we could get right back up into this 45, 46 level, these previous highs. And then I think it could break that and go way beyond there. So I think there's a lot of upside potential in miners in general. And when gold starts to get up near that 2,000 mark and starts to break out above that level, then we're going to see the miners, I think, really go ballistic. So I think there's a lot of potential for 100% return type thing in the gold sector, in gold miners, silver miners. I think they're going to have a pretty big move going
100%.
forward.
So 100% returns in the miners. You're talking about the junior side or the seniors?
The GDXJ more or less.
Okay, GDXJ.
And the SILJ. I think they've got the real explosive type of potential. I mean, the large caps should do well also, but obviously you get bigger returns with the smaller cap stocks.
And 100% return. What are you basing that on? Are you looking at specific catalysts that'll push it up, or are you looking at the chart patterns? How did you come to that conclusion?
Yeah, if you take a look, you can use a bunch of different analysis, but if we just take a look at the Fibonacci extension tool, we can look at this basic momentum target here. So based on where it is right now, we're looking at potentially this whole kind of consolidation and noise phase. We're looking at roughly an SILJ about 65% to the upside. Now that's just a really rough target based on this initial run and pullback. Overall, when we see gold start to break out, which if I take a look at gold is just starting to break out on the daily chart. And if we take a look, I mean, gold has this big pattern. Let me just go back one step here, David. If we go back here and take a look at gold, it's got this massive cup and handle formation, which is pointing to $2,600 gold. So as gold starts to break out to these new levels, this is when the gold miners are going to really start to take off. So we're going to have this resistance level. This one right here, it just broke. The next key one is really going to be right here. And we're going to have another significant one here. I think once gold gets above this 1965 area, that'll be two really, really significant levels on the chart where this whole kind of consolidation will have fully changed direction. It's now in this new leg higher. And that's when that breaks, I think that's when gold miners are going to go absolutely ballistic, because that's when long-term investors are going, okay, this is in a new renewed uptrend. It's broken all the major resistance. It should have enough momentum here to carry itself to 2,600. And that's a huge profit for the gold miners. So I think a lot of it's going to hinge around gold. It's going to be a very emotional play. A lot of people chasing prices up, which is how the markets move. And I think we'll see like another leg, just like we saw over here, a huge rally to the upside. I think that same thing will eventually happen over here as gold goes up to 2,600. So a lot of it's going to come down to gold having broken out of this huge kind of year-long consolidation.
Well, could this still happen at the same time? Well, you mentioned it probably won't happen at the same time as the stock rally. Now, you mentioned that you like tech sectors, the tech sector and the financial sector. So these are risk-on plays. If the sentiment overall in the markets is more risk-on, why would people be piling into gold, which is seen as more of a risk-off safety hedge instrument?
Yeah, I think people are still worried about currencies and what's going on over in China, the Everglade, the issue there. I mean, you look over in Asia, gold is a huge thing. I think that's part of the reason why we're seeing actually gold move up is because we're seeing probably a lot of money over there saying, where do I go? I mean, they're nervous to go into different assets, and gold is kind of, rock solid. And so I think we're seeing money rotate into there because investors don't know what to do. Overall, I think we're going to see gold continue to hold up as a global safe haven. That's the nice thing about gold is it's not just what American stocks are doing. It's actually what the whole world sees as risk. And Asia is a huge chunk of the population, massive money over there. When it gets nervous, it's going to be looking to go to maybe the US dollar, US stocks, probably want to go into gold. It's kind of one of their favorite assets, right? So that we are seeing that shift. I think that's part of why we're seeing gold move up and hold its value. So we can see gold and gold stocks rally with the stock market. I'm just saying, I think the gold and silver miners will become the market leaders a little bit later. I think they could rally with the stock market, but I think they might be outperforming technology and all that stuff down the road when they become really a hot commodity because gold is breaking out, right?
Right. You said gold is rock solid. Pun intended, of course, right, Chris?
Yeah.
You mentioned interest rates would rise, and some people would agree with you that eventually they should rise. Wouldn't that put downward pressure on both the stock markets and the gold markets?
Yeah, I mean, obviously, if you're going to get a better, higher yield somewhere, I mean, the yields are so low right now. I don't think it makes it's a huge concern. I mean, you're way better to take the risk on and be active in the stock market than plop your money somewhere for 0.5% or something like that. When rates start to get a little more substantial, I think it could be, it'll have a negative impact on the markets in general. But right now the rates are so low, a little bump in rates is kind of good for the financial sector, for financial stocks, which is why I like the financial sector. But there's just not enough rate there, I think, for people to bail out of the stock market and go look for some bond or something like that.
Overall, you think that the markets can handle a little bit of a rate hike?
I think they can. I think it'll be fine, yeah.
Okay. Now, you mentioned that after this explosive rally, well, particularly with the stock markets, we might see a crash. Is that why do we have to see a correction? Why can't it just stabilize and keep going? Or is that,
It could. Yeah, it totally could stabilize. I mean, when you look at the perfect example is the Russell 2000. The Russell 2000 had a massive rally. And what did it do? It just went stable. It created a strong base. And now it's launching out of it. It does not have to crash. The crash is going to be determined to me how we get to those lofty levels. If we see the stock market just go absolutely ballistic and we see money flow go into a whole whack of large cap stocks and momentum stocks and people just drive the market straight up. If this 30% rally happens in like a 2-month window and sentiment just goes completely extreme that everyone is just dumping in, that's usually a sign of a market top that usually is followed by a very sharp crash and correction that takes a long time. But if it takes several months to rally there and then it holds its ground without huge volatility, then it can do exactly what the Russell has done here. It just chops around for a bit. It stabilizes. People who are nervous, they sell their shares. People who are comfortable, willing to hold long term, they accumulate those shares and it holds its ground. So it's going to be like, do we have a bubble blow off phase in the next couple of months where it just goes pop and the market goes straight up? Yeah. And usually what goes straight up like that when it's an emotional trade, it'll come straight back down very quickly. And how the market reacts after that pop kind of stalls is going to kind of determine, hey, is this going to be a consolidation or was that like a top and we're actually going into like a crash phase, like a bear market phase? We won't know until we actually see how the price gets there, right?
Just one note about gold, because you talked about the speed at which something rallies. So if you notice in the past bull rallies for gold, 1980, 2011, last year, for example, all those three rallies, we saw gold spike up. Well, actually in 2011, it was over a number of years, but it fell dramatically afterward. I don't think in any of these examples you had gold perform like the Russell 2000 that you just showed, where it just sort of topped for a while and then showed a bit of an uptick later on. In all these examples of prior bull rallies, gold has spiked dramatically, outperforming other asset classes, but then fell back down. So, I mean, is that just the way gold behaves, you think?
Yeah, gold. I mean, gold has these very explosive moves. I mean, when we go back and we look at any of these kind of corrections along the way, we see price go up. It goes ballistic for a little while here. It looks dwarfed on this chart simply because we're zoomed way out with some bigger price action. But when price starts to go ballistic and goes straight up, week after week, usually it's going to come back and give back that last euphoric push. And this is the push that I'm talking about we could see in the stock market. We just see this really strong, everyone piles in, and then it's going to come right back, and then it's going to consolidate. And the question is it going to consolidate, or is it going to go into a bear market where it goes down? Now, gold held its ground here, and then it went off, and it ended up having another one where we can see here it had a huge run up. Eventually, it gets into this really strong phase where it starts to get consolidation. It breaks down, and it has a consolidation. This was a bit more of a correction. Obviously, gold pulled back. I think it was like
keep going,
30+%. So, I mean, gold can do both, and I mean, we've seen it happen both times. Over here, it did the same thing. This euphoric phase, which is what I'm talking about in stocks, could come straight back down. And then it's the question of, does it consolidate and go higher, or does it consolidate and start a bear market, which is what we're just coming out of now, right? This multi-year bear market.
Mm-hmm. All right, excellent. Let's watch out for that. This is what I like about you, Chris. When you talk about explosive moves coming up ahead, you're so calm about it. It's like this dichotomy in personality, but I like it. All right, Chris, thank you so much for coming on the show, and we'll follow up next time. Thanks for being here.
Thanks, David. All right, take care.
And thank you for watching Kitco News. Don't forget to tune in next Wednesday for the live debate between Alex Mashinsky and Peter Schiff, hosted by Michelle McCory. Questions will be taken live.